Ladies and gentlemen, if you've been with me on this journey, you know for a fact I've been bullish throughout 2023 and 2024. I said to buy the dip at every pullback and have remained consistent with my messaging. But the time has come to talk about the risks, and there are plenty. And this isn't some fear, uncertainty, and doubt. This is simply the facts. So let's roll the tape. Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and a very green day as investors digested Nvidia's earnings as well as some heavy-hitting news on the regulatory front with regards to Amazon and Google. And guys, there wasn't really much to say today. We saw outperformance in pretty much everything except the bigger names. In fact, Nvidia was green today, but we saw underperformance here in Microsoft, Apple, and then Amazon, Google, Meta. And it's probably best we just talk about all the red we see because everything was just green, everything was just rallying. Semiconductors actually taking a hint off Nvidia's earnings, guys. Like I said in yesterday's video, great earnings, the street recognizing those earnings. And I think we're actually going to see Nvidia rise significantly higher than what it is into 2025. But the biggest sore spot on the market today was definitely Google, down 4.59%. Amazon followed suit, and really the mega caps, Tesla, Meta, Eli Lilly, Apple, Microsoft, really weighed on the market overall today. And everything else was really green, and we're just sort of seeing a continuation of that post-election trade as some of the risks dissipate and some of the more bullish tailwinds come to full view. But let's quickly talk about some of the biggest movers in the market today. MicroStrategy, their shares were down 15% here today, mostly on the back of a short report by Citron Research. They said they entered a short position on MicroStrategy after the stock's 600% gain this year. Citron said that while the firm remains bullish on Bitcoin overall and was bullish on MicroStrategy's Bitcoin play years ago, the move in MicroStrategy stock has completely detached from fundamentals, and we saw the market take note of this news and sold off MicroStrategy quite violently into the close of the day. Google, this was a big one, down nearly 6% at the lows, nearly 5% for the day, and things are actually not looking too good. Now, that's because the Department of Justice came out and submitted a document in federal court outlining specific remedies after successfully arguing a landmark trial in which it claimed Google ran its search engine empire as an illegal monopoly. The DOJ asked that Google's parent company, Alphabet, sell off its Chrome browser and asked for a divestment of its Android mobile operating system or a contingent Android divestment based on the effectiveness of other conduct-based remedies. Most of the remedies would run for 10 years. Prosecutors also called for Google to divest within 6 months any investment or ownership in rival query-based artificial intelligence products, as well as rival advertising technology products and search distributors. So they're no more going to be paying to be the #1 search engine, and any initial investments in other AI companies, they have to withdraw that. This is absolutely crazy. The Android remedies are intended to blunt Google's ability to get preferential treatment for its search engine and ads business. The filing said they would likely constrain Google from requiring mobile devices that run on Android to include its search engine or AI products by default. So really what the Department of Justice is doing here is trying to attack Google's moat and saying, you guys ran an illegal monopoly, now you have to face the consequences. The street not liking what they're seeing, and I think this is going to continue to be an overhang into the start of the new year. I actually sold my Google position for a 12% gain after this news. I don't want to be in this name. I'm looking for other opportunities at the moment. And Nvidia, we have to talk about Nvidia, guys. The stock was down 2% in the pre-market, and then on the open, it was up 4%. So the street really liking what they saw with Nvidia's earnings yesterday. It beat on the top line, bottom line. Margins were a little bit weak. However, guidance came in line. Demand looks solid. Everything is going according to plan for the stock. Jensen doing a great job. And while the stock was only up 0.67% for the day, you have to understand that in the after hours yesterday, the stock was down at 1.5%. So we saw a huge surge from the lows into the open, We saw a bit of a pullback, but I do think Nvidia goes higher, probably closer to the 180 mark into the first and second quarter next year. And moving away from the market movers and looking at the indices in aggregate, the best performing index was the Dow Jones, up 1.16%, followed suit by the S&P 500 and the Nasdaq 100 green today, but only up 0.16%. The big tech names really weighing on this index for the most part, as well as the S&P 500. And you saw that the equal weight of the broader economy, the Dow Jones, performing really, really well. Guys, when an index is up 1% on the day, that's a fantastic move. And then looking at the sectors broadly, we only saw one sector underperform today. That was the XLC, the communications sector. And that had to do with the situation we saw in Google. We also saw underperformance in Meta as a result. That just has to go with index passive flows. But other than that, every sector was green. XLY underperformed the SPY returning 0.57%. And that just really goes to show the momentum we saw in the broad market. When the S&P 500, which is pretty much the Mag 7, is only up 0.57% and every other sector outperforms, that's a very broad-based rally. And again, just stemming off those election tailwinds as some of the risks dissipate as we go into the end of the year. You also have to understand, guys, that there is a ton of buybacks that need to be done from now until the end of the year in weeks where we have shortened trading days, Thanksgiving, Christmas, New Year's, etc. We have all of this buying that needs to be done and tax loss selling and then recollateralization of that money. That's just going to mean stocks go higher into the end of the year. And the winners this year are going to lead the charge. Stuff like utilities, financials, technology. They are the leaders this year and they really did outperform, all gaining 1% here on the day. Apart from large caps, it was a day for small cap. Small cap growth, small cap everything was up in excess of 1%. Small cap growth up nearly 2%. But we also saw mid cap growth perform really, really well. Large cap growth perform really, really well. But in aggregate, even large cap core, mid cap value, large cap value, and mid cap core still producing returns in excess of 1%. It just wasn't as strong as some of the smaller names and growth names we saw. Nonetheless, no matter where you were positioned in the equity markets, ex Google, you did really, really well today. And with all of the bullish momentum we saw, we also got some fantastic data. Initial jobless claims beat expectations. The data show that claims hit their lowest level since April, despite the recent uptick we've seen over the past several months. 213 initial jobless claims were filed in the week ending November 16, down from 219 last week, and this was below the 220,000 consensus expectation. The weekly claims report remains the best real-time monitor of labor market conditions, and the data show that the labor market is trending sideways at a healthy level. You love to see it. Something else that was very, very good today for the market was existing home sales month over month. The forecast year was actually for 0.8%. We actually got a 3.4% increase, and existing home sales actually beat the forecast and consensus expectations handily. So very interesting to see the trade there. So we got great housing data, great employment data, and that's why we saw a huge rally in the markets, along with the momentum trade that's been going on this year as risks dissipate and tailwinds invigorate. And looking at the global market, we actually saw very mixed action. Europe rebounded after the tough week it's had with geopolitical concerns. Asia was down significantly from China, India, as well as the Southeast Asia region and the Australasia region. We saw South America very mixed, and the real winners here today was actually Canada as well as the US markets. Very strong day globally ex-Asia, and we saw great market breadth. This is the advancing and declining issues on the New York Stock Exchange. 82% of constituents were advancing, 17% declining. Very strong market breadth, and when you look at it, now the short-term averages looking really, really robust. The medium-term averages continue to do what they're doing, and the longer-term trends remain intact. And that is why I've said, guys, you want to buy the dip because the longer-term and medium-term averages look very, very healthy, and the noisy 5-day looking good now. And we should see this translate into the 20-day, into the 50-day. If this momentum continues, momentum brings momentum, and we are in a momentum market at the moment. But let's hop on the charts. Now, equities had a very fantastic day. The S&P 500 up 0.53%, the Nasdaq up 0.36%, but the IWM, the RSP, mid caps, small caps, all up in excess of 1.6%. We saw outperformance in the broader market. Look at the RSP, very solid gains. We are seeing a little bit of overhang here in the after hours, particularly in the Qs. That's the NASDAQ 100. However, when you look at stuff like the IWM, down 0.05%, up 0.07% for the RSP, and the SPY only down 0.06%. It's inconsequential, really, but still mixed action in the after hours nonetheless. Now, I do want to take your attention to yields. Yields did rise today, and that was on the back of the stronger than expected housing data. And we also saw the dollar rise as a result. Right now, when yields rise, the dollar rises as well. And when yields fall, the dollar tends to fall. And despite the stronger dollar, we actually saw gold rise and crude rise. That geopolitical overhang that we saw in Russia and Ukraine is still there. The market's still positioning bullish into gold, into crude because of that geopolitical concern. We're just not seeing it in the news cycle right now because the headlines are dominated by Google, Nvidia, and MicroStrategy. Bonds were virtually flat here on the day. I still think TLT is looking great for a trade, as well as the AGG. The yields look really good there. You can lock that in. And all in all, it really was a day for risk assets. Equities were the place to be. But if you held gold, if you held crude, you did well as well. Silver actually falling, and that's telling us that the commodity trade, excluding any geopolitical hedging, is still a bit weak, especially with the stronger dollar and stronger yields that we are seeing in the market right now. Now, let's actually have a look at the charts, right? I want to bring your attention to the NASDAQ 100 because we were eyeing up two things, and go watch the weekend video. So on Friday, this is Friday's candle right here. We said when we closed the weekend, we were looking for two things. We were looking for a pullback to the gamma flip, and then we were looking to make the next move after that pullback. And that next move was either going to be a move up after Nvidia's earnings, or we were going to pull back and go to the put support. That's exactly what we did here on Monday, Tuesday, and Wednesday. We actually saw bullish momentum to the gamma flip. We did see a little bit of hesitance, especially when you look at this wick right here. However, buyers came in a very big way yesterday and today, and we actually cleared the gamma flip, meaning that we now are probably going to go ahead and close this gap. That's our next target, and then we can look to the put support. For those of you that are new on this channel, we have the gamma lines. This is the gamma flip zone right here. This is the put support, and this is the call resistance. Pretty much, if we're above the gamma flip, we're in positive gamma. In a positive gamma environment, dealers buy dips, sell rips. That's how they hedge their options position. In a negative gamma environment, dealers sell into weakness, buy into strength. In positive gamma, we generally see this type of price action, right? In negative gamma, we generally see this type of price action, very volatile. Either way, when we're in negative gamma, we want to buy the put support, looking to break into the gamma flip like we saw this week. Now, we didn't quite get there, don't get me wrong. However, we did find a low right here, and now we've cleared the gamma flip, and that means the gap we made from Thursday into Friday is our next target, as well as the core resistance at 21.95. A very similar situation ensued with the Russell 2000, except we actually broke the put support right here. This wick was looking very, very ominous. However, it was a wick, and we saw strong buying action. Sellers did come in at the top here with the IWM, but we are officially in positive gamma for the IWM. This is the Russell 2000 index, and guys, when you look at this, right, we're just seeing higher highs, higher lows. This is the 52-week high, and like the NASDAQ 100, and our target right now is the core resistance at 24.20. The S&P 500 has held up really, really well. It stayed in positive gamma, so had you bought the gamma flip, like I said, you guys should this entire week. We actually did go ahead and close that gap, and that means the 6,000 level comes into view. We saw strong buying. Buyers stepped in a very big way right here. Look at these wicks, right? And we also managed to close the Thursday into Friday gap. You love to see that. Now, there is a little bit of risk in this market, right? And that has to do with the selling we saw. Let's actually hop on the daily chart, right? We did see a little bit of selling here at the highs for the S&P 500. We saw a very similar situation for the Russell 2000. We did see selling at the highs, and we actually closed at the lows from that selling if we actually just take everything from here. So that is a little bit of headwind risk. If we look at everything in aggregate, we go go on the daily chart, right, we did see a little bit of selling right here. Did we see that in the NASDAQ 100? Not as much, not quite as much. And then the S&P 500, we also did see a little bit of selling. Also, you do have to understand that this is a wick. In other words, sellers did push us to the lows of the day. It's just that the bears bought the dip and took us higher. So the bears are definitely still active in this market, and that is a risk we do need to be aware of, all things considered. However, guys, when we do zoom out, let's just look at the 3-month chart. Actually, no, let's look at the year-to-date chart and just zoom in. What we really saw with the price action we're seeing recently, the low we put in right here, that's a higher low relative to this low in the S&P 500, and this right here is an all-time high. This is constructive price action, especially when you look at it in the context of the year. Higher highs, higher lows, new all-time highs. Very similar situation to the NASDAQ 100. This is just a higher low, relatively speaking, and this is all-time highs. That is our target right now. And the IWM, the RTY, the Russell 2000, while not all-time highs, that's a 52-week high, and we're about 2% away from all-time highs once we clear this level. So very, very strong momentum. Technically amazing looking charts. Equities look very, very good. And I think no matter where you are positioned in equities, you should do really, really well. But you definitely want to look at higher beta. For those of you that don't want to invest in the Russell 2000, some of you know I'm a big proponent of small cap quality. One of the indices you can look to is the small cap cash cows ETF. Another one is XSHQ. That's a tongue twister. I like this ETF as well. It's everything in the Russell 2000 except the profitable companies with high growth rates and high return on invested capital. I like the small cap quality ETF, a fantastic ETF. For those of you that want more mid cap focused ETF, look at the MOAT index, okay, MOAT. It's wide moat companies trading at a discount. I really like, and this ETF has actually outperformed the S&P 500 in the last 10 years. A fantastic ETF. If you're looking at individual names that I like, Econmy Software, guys, this stock is trading at fair value, but this is a high quality company with no debt that's expected to reaccelerate revenue into 2025. You always want to buy great companies with reoccurring revenue at fair value. I think we're slightly under fair value for this name. I like Econmy Software. I also like PayPal as well, although things are getting really frothy with this name, trading at $84 and a high of 87. Kind of crazy. Nonetheless, I am bullish on PayPal. And another name I also like is just Meta. If you're looking for a mega cap, immense earnings power, wide moat. So if you're looking at individual names, look at those names. If you want ETFs, look at those. But guys, everything looking really good. Equities poised to go higher. There's so many tailwinds. You don't want to fight the trend we're seeing right now. The markets look technically sound. We're in positive gamma across the major indices. In this type of environment, you should already be long. Hold equities because there's still more gains to eke out into the end of the year. And let's talk about sentiment. This is the AAII sentiment survey. And after the Trump rally we saw in the week of an election, we saw bullish sentiment rise to 49.8%. Guys, anytime this gets to 50%, we normally see a pullback, and that's exactly what we saw in the past week. Bullish sentiment ticked down to 41.3%, but this is still cyclical highs where the average bullish sentiment votes hovers around 33%. So to see 41.3% still tells us there is plenty of bulls in the market, despite the price action we've seen in recent weeks, a bit of a pullback. But while the markets have actually had a little bit of a pullback, we've actually consolidated at pretty much all-time highs. We're about 1 or 2% away from all-time highs in stuff like the S&P 500 and NASDAQ 100. And when we are that close to all-time highs, people generally remain very, very bullish. We did see an uptick in bearish sentiment as well as an uptick in neutral sentiment. And this is telling us one thing. Those that were in the bearish camp flipped neutral and flipped bearish as well. All things considered, we did see a downtick in sentiment that did coincide with a pullback in markets. We did see that in the last week. However, when you look at everything in aggregate, the fundamental picture remains sound. 449 companies have reported an 8.6% earnings growth rate for this quarter. At the start of earnings season, it was 4.7%. So we're seeing a huge beat here, guys. Margins continue to expand, revenue continues to beat, and if we just remove the energy energy sector, which is the small component of the S&P 500, we actually see earnings increase significantly to double-digit earnings growth. So all in all, when you look at this, the fundamental picture is sound, both on the revenue side, the earnings side, margins expanding. And guys, when earnings are growing, margins are expanding, stocks do very well in that type of environment. And that is why I've been bullish and remain bullish for most of 2024 and 2023. But one thing we need to look at is where we are in the market right now, particularly with valuation, because we are at historic high valuations. We're just a stone's throw away from the highs in valuations we saw in 2021 before the massive 2022 sell-off. And generally speaking, when global equities have had a high valuation, the next 12-month returns are generally only good if earnings revisions are positive. Current valuations are sitting at 18 times, and when valuation has been greater than 18 times, with positive upgrades in earnings, we've seen a 10% return in the next 12 months. But with negative downgrades, we've actually seen a 2% return, and that is why valuation really matters. So unless earnings actually materialize according to market's expectations, which are lofty expectations, the path of least resistance may actually be to the downside. However, when we look at the current quarter, we're seeing a pretty massive beat, and if this is to continue, we should see outsized returns, market-beating returns, double-digit returns, looking 12 months into the future. And you can't deny the fact that this rally has been very strong. In fact, the returns we've seen here in 2024 rank in the top decile of returns. We've seen returns of about 23% this year, and even though we have seen a little bit of a market pullback, when you look at everything in aggregate, very bullish, and you don't really want to fight the trend. All you really want to do is buy dips and look to higher price action in the S&P 500. That's all you really want to do. You do not want to fade this, because bull markets can go on for a lot longer than you think. And another reason why you don't want to fade the market right now is simply because of the fact we are in a very bullish time period, particularly right now. From the Tuesday before Thanksgiving all the way to the second day of the new year, we see average returns in the S&P 500 2.58%, in the Russell 2000 3.34%. The hit rates are very good, 79, nearly 80%, and 77% here in the Russell 2000, with fantastic risk to reward, all things considered. So guys, yes, I do understand valuation looking frothy right now, but earnings are backing up that valuation. Sentiment is still very bullish. We are in a momentum trade, and seasonally things are looking very bullish. So all in all, you want to remain constructively bullish in this market. You want to hold risk assets. And when you look at Goldman's returns for 2024 and 2025, they see very much the same thing that I do, especially what the data is telling them. Let's just have a look at their base case. The S&P 500 Q4 2025 forecast 6,500. They see Europe equities returning at 2150. That represents 10% returns. Topics, which is Tokyo 3000, again double-digit returns. And emerging markets are not that great, only 4.1% returns. And the place you want to be is developed market equities for 2025, at least according to Goldman. And diving into the macro, looking at the economy, this is the Fed's GDP now. We saw a slight 0.1%, a 10 basis point uptick in the Fed's GDP now, sitting at 2.6% at the moment, well above the blue chip consensus, and telling us that economic growth and expansion looking very robust. Also, looking at federal tax receipts for the month of November, 7.4%. We've seen very robust tax receipts, except here in the December period 2023, where we saw a decrease of 8.6%. Other than that, we've seen very good federal employment tax receipts, and this is telling us the consumer is strong, employee compensation is strong, disposable income is likely strong as well, and looking very robust in the month of November. However, take this with a grain of salt. After today, comparability in November actually suffers a bit, because last year Thanksgiving fell on this Thursday, whereas in 2024 it falls into next week, which is next month for the cutoff this Friday. So we should see a little bit of a weaker print, very similar to what we saw here in 2023 in the month of December. All in all, though, it doesn't really matter, because tax receipts look looking very robust. And guys, profit share as a share of the economy are near their peak, but challenges could be on the horizon because inflation is cooling and businesses may struggle to raise prices as a result, limiting growth. At the same time, rising credit rejections are leaving consumers with less spending power, which could weaken demand. If costs like wages stay high, profit margins could get squeezed. Next year might be a tougher year for businesses to maintain profitability in this challenging landscape. But this is specifically small and medium-sized businesses, not necessarily public companies with immense pricing power. There are risks in this market when you look at everything in aggregate, and the strong wage growth might not continue into 2025, but in the year and now, things looking very, very good. And then looking at earnings for the rest of the week, guys, there's not much. We just got two big names, Global Blue and ADEX. That's really it in terms of data. Tomorrow we have the PMIs, the composite manufacturing and services, as well as UMISH final sentiment. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.